Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the 3 catalysts for watching this hour. First up, stocks reversing earlier losses as investors digest fresh earnings and data. We unpack the status of those trade negotiations as well with the U.S. and China. Plus, we'll discuss the positive and negative impacts of tariffs on the C-suite. We've got Southwest Airlines and WhirlPool CEOs, along with ServiceNow's CFO. And recession-proof stock picks. One investor shares 2 names that could potentially weather a downturn. We'll get you those picks later in the show. Half hour into the start of U.S. trading, let's get you a check on the markets. Let's take a look at the major averages to start. It appears as if you're still seeing movement to the upside here. You've got your tech-heavy NASDAQ up over 1.3% here. Your S&P 500 up about 0.75%. Of course, gearing up to hear from Alphabet and Intel after the bell. Those tech-heavy names will, of course, be impacting the major averages. But I want to flip the board over to the bond market. Really interesting to see yields continuing to come down. Treasuries getting just a bit of a bid here. This comes, by the way, off the back of commentary from the Fed's Beth Hammock saying that the Fed could be ready to cut as soon as June. You've got your 10-year down about 6 basis points at the moment here. But finally, let's take a look at Bitcoin moving to the downside, down just about 0.1%, but still holding above that 92,000 level. And stay tuned all morning long on Yahoo Finance. We're bringing you C-suite commentary from Southwest Airlines, WhirlPool, and ServiceNow. You won't want to miss it. I also want to bring in friend of the show, Joe Brusuela, is an award-winning economist with more than 20 years of experience analyzing this industry. He currently serves as the chief economist at RSM. Joe, great to have you. I'm excited to have you for the entire hour, but I am hoping you can start off by helping me understand where you think we're at right now. Obviously, these negotiations, every day, every second, there's a headline that they're happening. There's a headline that they're not happening. Where does that leave the state of the economy in this moment?
Well, between the U-turns, pivots, and changes in policy, to be honest with you, the market doesn't know. But at least this morning, things have calmed somewhat. I think that's off the back of the news that perhaps we won't see tariffs on auto parts imports from China. That seems to be put a bid in the market. Okay, all's good, but we'll wait to see what happens later on when people start to talk, right?
Yeah.
I think the important thing to think about here is that the economy is going to slow. When I heard Beth Hammock this morning talking about rate cuts by June, I thought, well, this is good news going to turn in, or bad news is going to turn into good news. If the Fed's cutting in June, it's because the economy's rolled over.
Yeah.
Markets responding to the idea that, well, perhaps there'll be lower rates. Okay, that's fine, but we're going to have to address that. You know, let me go real deep inside the real economy here for you. If you take a look at expected incoming traffic into the Port of Los Angeles, it's going to decline 44% between now and May 10th. In June, what that means is there'll be less goods on the shelves.
Right.
Less goods equals higher prices. At a time when inflation goes up, that means less disposable income, less demand, and you can see that in the earnings data this morning, whether it be the announcement by Southwest or probably more pertinently the announcement by American Airlines, no forward guidance. You know, I fly around. One of the big privileges of my life, Maddie, is I get to go around and talk to people all over the North American economy, especially here in the United States. Last week I was on a plane from Southern California to Las Vegas. There was 10 of us on the airplane. That's it.
That's not good.
When you see that sort of anecdotal evidence, and again, I arrived yesterday from Washington, D.C., very much a similar outcome.
What is your favorite recession indicator at the moment, and where does it leave you thinking about where the economy is heading?
If I'm going to look at recession indicators, I'm going to go straight to transportations. Shipping, trucking, and trains. That will give you, I think, the best sort of tip of the spear. Then in terms of the labor market, obviously initial jobless claims. Now that's the dog that hasn't barked yet. 222,000 for the final week. That's right on the 13-week moving average, which is the metric I use to watch that. So we haven't seen that yet, but this is going to be a different type of economic downturn because it's policy induced. This isn't an exogenous shock having to do with a financial crisis, an oil shock, or even a pandemic. This is caused by a trade shock, which has turned into a financial shock, and we're going to expect to see orders, prices, and hiring follow, but that's going to be a bit. Really, we won't see that materially until June. That'll be for the May data, July for the June data, and then August for the July data. By then, you'll see prices move higher, orders roll over, and probably you're going to see the first real cracks in the labor market.
And I think the key question, too, is even if we were to get a negotiation, is it enough at this point to soothe all of these fears? That's going to be the key question that we will be asking our guests throughout the hour. Joe, you're going to stick with us for those conversations as well. It'll be great to have you. Thank you so much. Appreciate it. China is denying any progress in the talks with the U.S. Commerce Ministry spokesperson calling the claims of ongoing negotiations, quote, groundless. While President Trump's team touted advances with Beijing earlier in the week, China now pushing back, saying, quote, the U.S. should thoroughly remove all unilateral tariffs if it really wants to solve the problem. So where do things go from here, and what does it mean for investors? Joining us now, Michael Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. Also, Brian McCarthy, the Managing Principal and Chief Strategist at Macro Lens. Thank you both for being here this morning. Brian, I want to kick it off with you because I want to get a sense of the geopolitical aspect here. China throwing cold water on the idea of these negotiations. From where you sit, how likely is it that there actually is going to be a deal between the U.S. and China at this point?
There will be no deal between U.S. and China. If there is any deal, it's an indication that President Trump will have folded under the economic pressure, which could be intense. China will never make a deal that involves rebalancing its economic model. That would require really a change in the entire philosophy of political economy in China. So forget about China making a deal that gives the U.S. what it wants. What is all this really about? It's about global superpower status. Effectively, the U.S. and the West has developed supply chain dependencies that, if they don't already, will call into the question the U.S. ability to deter China from doing whatever it wants geopolitically. So I don't think President Trump would have gotten into this if he wasn't ready for a big battle, and we're looking at one.
So, Michael, how do you respond to hearing Brian say that a deal, it's not likely? What does that mean for markets?
Well, unfortunately, I agree with much of what Brian presented. I would suggest that the Trump administration probably underestimated the impact of the personal and the personality associated with delivering the message. Trump is very broadly despised within the diplomatic corps around the world. That has meant that Europe has reacted negatively, Canada has reacted negatively, even Japan has reacted negatively, and China is taking advantage of that. Ultimately, China is incredibly dependent upon the United States and the rest of the world to absorb the excess production that it needs to create in order to maintain its economic model. I'm a little bit less sanguine on China's ability to extend this for an extended period of time. They have their own internal challenges, but certainly the Trump administration has created the option for them to exploit this. In terms of the market implications, I think, unfortunately, we are seeing that every time positive news comes out on trade, the markets will react positively because they know that's what needs to be resolved. The credibility of the Trump administration in terms of speaking towards settlement or towards progress is becoming less impactful over time. So the rally we had a couple of days ago or yesterday was far less than the rally we had before. Much of that has faded. My expectation is that at some point we're going to have to see this resolve itself, as Brian alludes to, by the Trump administration likely rolling over at this point.
All right, and my guest host, Joe Brusuelas, also has a question for you.
Yeah, I got a question for Brian. Adam Posen, who runs the Peterson Economic Institute in Washington, former Bank of England member, wrote a very provocative article on Foreign Affairs this month talking about the use of escalation dominance by the Trump administration, which is a core tenet not only of game theory, but the escalation ladder and nuclear deterrence. Did the Trump administration escalate actually having all the cards? Or did they not think through what China had been preparing for over the past 10 years?
Yeah, no, I don't think the administration was under any illusions about how difficult this would be. You said the Posen paper was provocative. It provoked me into writing a response that I sent to my clients last week. He said that China's only vulnerability is we're vulnerable because we get goods from China, but they only get money from us. He completely overlooked, Mr. Posen did, that China has very acute balance sheet problems already. And when the money stops, so does the ability to service debt of the firms that were collecting that money. So China not taking in money is a huge problem. They're facing a pincer move from the US now, where China will have acute liquidity problems because its domestic balance sheet, already in bad shape, is going to be put under further dramatic stress. At the same time that they need very abundant domestic liquidity, they are going to see a sharp contraction in the availability of dollars in China because their trade surplus is going to get cut dramatically. And I believe Chinese banks are going to be cut off from borrowing dollars, which they've been doing quite actively from international banks. This is a very bad cocktail for the RMB, and I see China as far more vulnerable than people understand.
Well, I'd like to give you a follow-up. If that's the case, then one, why won't China come to the table and negotiate? And then two, it seems to me the Chinese moved all of the production offshore that's pretty elastic, right? What we import from them, we can't get from anywhere else. So how do you cut that Gordian knot? How do you square that circle so that we get to yes on this?
China's approach to these things is always don't talk, fight. So their response would have been entirely predictable to the Trump administration or anyone else. It was easy to foresee. So if the Trump administration has made a mistake here, it's an egregious one, because China has not done anything you would not have expected. And yes, I'm not saying this is not going to be painful for the U.S., and China's bet is that they can withstand more pain. One ironic thing here is the U.S. needs to stop talking down the dollar, because the pain point for China is their currency. Mm-hmm. And in a weak dollar environment, they can produce more domestic liquidity and kick the can. So there's a catch-22 in what the U.S. is doing here. They need to attack China through the currency because this is a game of who can take the most pain, and China's betting that the U.S. will fold in the short term.
And I've also heard from some of my sources that a weak dollar maybe presents a positive catalyst for stocks. Michael, I want to give you the last word here. Where do you see stocks heading, given all of the headwinds here, plus one that we haven't even talked about, which is that people are buying the dip on stocks that were already perhaps overvalued?
Well, the buying the dip phenomenon is a byproduct of the way that we invest in the United States. As long as you have a job, you contribute to a 401k, your employer matches that. No decision process was involved in that. And we've really seen that play out with continued inflows, particularly coming from retail. The key sell-off that we've seen so far has actually primarily been European and to a lesser extent Asian investors pulling resources home once the Trump administration reminded them that they needed to spend a lot more money at home. That has led to the relative weakness of the US dollar against many of our trading partners. If you're going to try to balance that goods account, you're going to end up hammering the services side and the currency, the financial asset side of the balancing components. The simple answer is that the next stage in this process is the news from companies about how they have been impacted by the tariffs and the disruption to world trade and the uncertainty that's emerging in the United States. As we approach the next earnings season, I think we're going to see more and more information there. My gut reaction at this point is that we will likely revisit the lows that we saw earlier in April and to a certain extent March. And at that point, we'll probably see some form of relief rally that actually starts to take hold. But so far, we're just not really seeing that negative news yet because all the data is delayed.
You know, you teed up the rest of our show so well, Michael, because we have 3 C-suite guests making an appearance on Yahoo Finance to talk to us about what they're seeing. So thank you for that. Appreciate it. Thank you, Brian, as well, for joining us. Really appreciate your insights.
Thank you.
Thank you.
Coming up here, Southwest Airlines joining its peers in pulling full-year guidance. CEO Bob Jordan is joining me live with more on how the company's navigating the uncertainty. Stick around. Southwest Airlines pulling its full year 2025 and 2026 guidance, citing macroeconomic uncertainty. The company saying it is difficult to forecast given recent and short-lived booking trends. The carrier also planning to reduce flying capacity in the second half of the year. Joining us now, Southwest Airlines CEO Bob Jordan and my Morning Brief co-host Brad Smith for the interview. Bob, great to have you on with us. I want to get a sense of the degree to which these results were driven by the economic uncertainty caused by tariff policy. If you had to put a percentage on it, how much of your results were driven by the uncertainty caused by these tariffs?
Well, first, I'm really proud of the execution in the first quarter. We had terrific operating results. We really beat our cost plan. We had good revenue results. So all of our initiatives are on track, so the company is doing great. But no, we were highly impacted on the demand side by the tariffs and then just the consumer confidence erosion. When we started the year in January and had our expectations for the first quarter and the second quarter, since then, the first quarter fell off about 3 full points. And the second quarter has fallen off about 6 full points compared to what we thought in January. So that gives you a good indication of the level of impact on demand and just how rapidly the decrease in demand fell.
And so with that in mind, Bob, as you think about the difficulty right now it is for you and your airline peers to really forecast in this environment beyond what the bookings look like for the next 60 to 90 days, just take us into the modeling and how you and the team are going about that.
Well, first, you've got to come into something like this in a strong position. We have a strong balance sheet. We have net cash, not net debt. We are very well positioned. We already had very low capacity for the rest of the year. So you've got to come in prepared because ultimately, looking forward, it is really hard to predict what bookings will look like. The other thing is we have a really strong transformational plan. Cost levers, a lot of revenue levers. This past quarter, we turned on Expedia as a distribution channel. We started optimizing and dynamically pricing our Rapid Rewards redemptions. Coming up here in just a few weeks, next month, we've got our bag fees that'll come online. We are preparing for the extra legroom and assigned seating. We start to retrofit our first aircraft next month. So the good thing at Southwest Airlines is we have a plan and a set of initiatives that will fight against this environment, and those are unique to Southwest. So we are very well positioned. You know, the macro is going to do whatever the macro is going to do, and we are focused on what we can control, which is executing our initiatives, having a strong operation, and then really strongly controlling our cost base.
Within that, what are the realities of that capacity control that you're kind of evaluating right now, as it seems the rest of the industry is using that as one of its levers where it can perhaps take the cost of flying out of the equation, at least in this interim uncertainty? We
already had low capacity plans for 2025. We were planning to grow between 1% and 2%. We've cut another 1.5 points out of both the third and the fourth quarter, really taking out those lower demand off-peak flying. And you do that early because if you do that early, then you can take out the costs that are associated with those. So we'll have very low capacity this year, and all of that growth is funded by initiatives. We're taking 5 minutes out of every turn in 19 stations right now, and that basically and effectively creates extra new aircraft, and that's what's funding our growth. So all the growth is funded by initiatives. But no, we have a very low growth profile, which makes perfect sense in this very uncertain demand environment.
Bob, we've heard from several other CEOs over the course of the week, both in terms of our programming and other networks reporting that other CEOs, specifically in retail, have been meeting with President Trump at the White House, speaking about the negative impact of these tariffs. Have you scheduled a call with the White House? What are your comms looking like with administration officials?
We were speaking to the administration a lot on a number of fronts. On this, on work that's underway to really modernize the air traffic control system. That'll help the whole industry in terms of efficiency. But no, we're talking to the administration often on this and other topics.
You know, with that in mind, what are you hearing from the administration on safety of air travel? And we know that for some of the headlines that consumers will see and that much of the flying public will see, it does insert, once again, the reality of, okay, yeah, there are things that we have to, of course, keep our head on a swivel around, but there is so many requirements that come into place for everything within the air travel experience, from the flight hours that a pilot has to take in order to even pilot a plane, and then for all of the safety mechanisms for passengers as well along the way to be in compliance with the travel experience for everybody else. How are you navigating what consumers are feeling right now in the first quarter and coming off of the first quarter of this year of some of the unfortunate headlines around air aviation?
Well, you start with air travel is the safest form of travel on the planet. And just start there. You know, there are opportunities to improve, of course, but it's a very, very safe form of transportation, safer than a decade ago, safer than 2 decades ago. What we really need is investment in the air traffic control system. That's both staffing and then it's modernization of the systems that are used. I've spoken with Secretary Duffy a lot, and I'm very encouraged by his focus on modernizing the air traffic control system and getting the funding to do that, making that funding stable, and then really making progress in terms of modernizing the system. We need to lead the world in the efficient way that we can use the system that's available to us.
You know, Bob, I want to come back to something that you mentioned a moment ago, and I know we're limited on time, so we got to go rapid fire here, but you mentioned the bag fees. That makes everybody's ears perk up here a little bit. Why was this the move to decide to make right now, and just how much of an additive to the financial performance do you project that it could be?
Well, it's a collection of things. It is introducing a new basic economy fare. It's bag fees. It's introducing flight credits that now expire. It's introducing extra legroom section to derive more revenue. So that whole combination is expected to generate an incremental $1.8 billion in EBIT from those initiatives here in 2025 and $4.3 billion in EBIT in 2026. So it's very, very meaningful in terms of contribution to the financial side of the business. At the end of the day, we've got to offer the products that our customers want, and we've got to meet the financial returns that our shareholders expect. With bag fees, the good thing is for our customers, especially our most loyal customers, the product that they see in a lot of cases will actually be better. They'll have access to the seat map. A credit card holder will get a free bag. A customer that has tier level will get a free bag. So in a lot of cases, this is actually better for many of our customers. But no, you've got to drive the right level of revenue production. We have always led the industry in terms of our financial performance, and we are going to lead the industry again.
30 seconds left, Bob. There's evidence in consumer sentiment data that what consumers and your customers want the most is for these tariffs to go away. What is your message to the administration specifically about these tariffs?
Well, you know, the tariffs, there's a lot of focus on the impact of pricing in terms of the tariffs. I think the biggest thing right now is the impact on the economic uncertainty and therefore the consumer uncertainty. That's the biggest impact of tariffs at this moment, because we need that uncertainty to go away so that we can return to the right level and correct trends in terms of travel. Travel is incredibly important to the economy, and this level of uncertainty is making it very difficult to predict, and it's very hard on the economy.
Bob, we've had you here in studio before. You're not a height challenged person. You're telling me the seats are going to get smaller, larger. What's happening?
No, the seats are not getting smaller,
okay,
I
thank
assure
goodness.
you. We're going to have terrific seating and spacing for everybody. We're simply adding a section of the aircraft that is now premium extra legroom. And I cannot wait for that day to come. We'll be selling that in the third quarter, operating that in the first quarter of 2026. And again, we are beginning to retrofit those aircraft starting next week.
Bob Jordan, thank you so much for making the time. Really appreciate it. Of course, Brad Smith for bringing us the conversation.
Thank you both.
Let's get a check here on the markets. Super interesting moves in the markets this morning. We had the Federal Reserve's Chris Waller saying this morning that central bank independence is critical for the U.S. economy, also saying that a serious drop in the job market could prompt more cuts sooner. The idea that we're having multiple Fed speakers today coming out and saying that there could be a potential of more rate cuts sooner, leading to perhaps an idea that the Fed put, maybe it's still in play here. You've got your S&P up over 1%, your tech-heavy NASDAQ up over 1.5%. Of course, the question, if the Fed's going to cut sooner, what does that mean in terms of pain in the economy that led to that earlier than expected cut? That is the key question here. Coming up, even more C-suite commentary here on Catalyst. CEOs of WhirlPool and the CFO of ServiceNow. Stick around. Let's take a look at shares of WhirlPool this morning, reversing earlier gains down just under the flat line here. The company maintaining its full-year outlook and saying it believes it will benefit from tariffs in the long term, with 80% of its manufacturing done here in the United States. For more on what's next for the company, we've got Mark Bitzner, WhirlPool Corporation Chairman and CEO. I'm also joined by Yahoo Finance Executive Editor Brian Sozzi. Mark, thanks so much for making the time for Yahoo Finance. I've heard you call yourself the canary in the coal mine for the consumer. Tell us what that consumer is singing today.
Yeah, Madison, first of all, and Brian, thanks for having me back on the show. Yes, we do have a good sense for what's going on the consumer side. Just to put it in perspective and also relating back to my prior speaker, Bob, he was talking about the bookings a couple months out. Our order pipeline typically is 6 to 8 days. So we get a pretty fast sense in terms of what's happening with consumer sentiment. And what we saw on the consumer side in Q1 is actually, even coming out of election, there was actually quite a bit of a positive spirit out there. Consumer confidence was not bad. Actually, we saw a very strong sell-through in discretionary sales. And I think amidst all the uncertainty, which we all experienced, kind of starting mid-February and continuing, consumer confidence has dropped and the discretionary side of demand has dropped quite a bit. So what we do see right now is a strong replacement demand that has kept up very strong since COVID. But the discretionary side, yeah, it took its toll, and right now we don't see it even in Q2 so far recovering.
Mark, good to see you as always. Just hopped off your earnings call that ended a little while ago, listening to it live on Yahoo Finance. Very excited about that for the first time. You sound pro-tariff. Why?
Well, ultimately it comes down to we're a U.S. producer. I know there are many companies who now talk about reshoring, onshoring. We never left. And what I mean with that is, more than 80% of what we sell in the US is produced in the US. We have 10 large factories in the US. We have a long heritage of producing in the US. Actually, it's only 5% of our sales actually come from Asia. So we are a US producer. So are we faced with some headwinds? Yes, but they're manageable, large on the component side, and what we refer to in our earnings call, the loading which we've experienced by Asian competitors. But ultimately, as US producer, we will benefit from it. And that's why we're pro-tariff in terms of, but I want to clarify, we're not asking for an exemption. We're not asking for subsidy or gifts or handouts. There are some loopholes which exist in the tariff landscape today, which we just want to be closed, and then we're all good.
How do you mitigate the impact of tariffs?
Again, there's a manageable amount of tariff headwinds, and we enlarge on the component side and the preloading. So the mitigation so far has been, we had a number of price increases over the course of the last 12 months, which helped us mitigate the cost impact. The other part is we doubled down on cost takeouts. We kind of, in particular after January, we started, we've always been cost disciplined, but we kind of really doubled down on our cost takeout efforts on the variable product cost. And yes, there's some what we call rewiring of our supply chain, which occurs right now. It is limited because we're a US producer, but on some components which we so far sourced in China, yeah, we're looking at where else can we source them. There's sometimes limited supply base. And we have a very limited amount of finished goods coming out of Asia, which we're also trying to rewire supply chain. So these are, by and large, our mitigation actions on the headwinds. But again, I want to point out, once the tariffs fully kick in, we do expect some tariff tailwinds benefiting our US production.
I understand what you're saying, that you're not fully exposed to tariffs and therefore you're a bit immune, but historically you have still raised prices even on non-tariffed products. If we take a look at a historic example here, we have the administration's tariffs on washing machines specifically the first time that the president was in office. And even though that obviously impacted washing machines, we also saw you lifting the prices for dryers at the same time. And as you know, that means consumers did bear the brunt of that policy impact in terms of prices. If we see similar tariff measures imposed this time around, should we expect a repeated dynamic here where you lift prices on some of those goods even if the tariffs don't require you to?
Yeah, Madison, I'm glad you raised this 2018 washer tariff story because I think honestly it's time to debunk that myth. And let me explain a little bit. Because what that refers to is a research, and there's some internet articles which came out. Apart from a database, because it's largely CPI based, and in today's world, we only look at online pricing. But here's the story. The story on these articles was, well, the tariffs in 2018 raised prices and consumers paid for it. So here's the real story. Once the tariffs came into play, the Asian producers were caught by surprise and finally started putting factories in the US. They didn't do it before, they didn't do it after. So of course there was initially a shortage that drove to an increase of prices for a very short period. Once these factories came online, the prices actually came down to pre-tariff levels. Then subsequently, and this is what the studies got completely wrong, the prices raised again. That was obviously, why would the price all of a sudden raise 2 years after the tariffs came into play? Simple reason, there was a thing called COVID, where nobody had supply. So yes, during COVID, prices raised. Now, the more relevant thing, and I think this is getting lost in all this discussion, and it's important to set the record here straight. So now we're 7 years after these tariffs came into play. So today you have 2 factories more in the US. They're competitive factories, but they're 2 factories more, which didn't exist before. And again, after the tariffs, no Asian producer ever opened a factory again. So it was during these times, so 2 factories more, and the prices are down to 2014 level. Now, how many products do you know where the prices are back to 2014 levels? Honestly, I wish eggs would be on the level of 2014 prices. So today, from that perspective, consumer pays less than 10 years ago or same, and we have 2 factories more. So in my view, call me pro-tariff, but in this case, the 201 tariffs back then worked.
Yeah, good luck with that egg call out, Mark. I don't think they're going back to 2014 levels. But let me ask you this before we let you go. So you make products around the world. You have 25 locations, if I'm correct, 16 countries, 10 manufacturing plants in North America. Is what's happening on the tariff front, are you more inclined to tell your board, hey guys, I want to build 2 more plants in the United States, and if it takes 5 to 7 years, so be it, I need this capital. I mean, are you more inclined to just close those other sites?
Yeah, so Brian, first of all, from a global footprint, our factories are largely region for region. So basically what we sell in North America is produced in North America, what we sell in Latin America is produced in Latin America, same for Asia. So that gives us already a natural tariff hedge. Right now, in particular, as it comes to North America, honestly, we have capacity. Right now, I would say our factories are underutilized. We had to make some difficult decisions in the past. So we have real capacity to fill it. And that, I think, in this broader tariff discussion is a big difference to other industry. This is an industry where you have US production. So I understand it's different in other industries where you might not have production. We have production, we have capacity. Now, to be also clear, and this is maybe coming back to some previous comments made, once you have predictability on tariffs and stability on tariffs, yes, I think we would double down on our investments in the US. Actually, we spoke with the administration and we laid out some clear commitments which we would do above and beyond what we have already in the US. And I do see a significant potential surge on production in the US.
Mark, thank you so much for making the time. Whirlpool CEO Mark Bitzer, and of course Yahoo Finance's Brian Sozzi for bringing us the conversation. Thank you both.
Thanks for having me. Thanks.
Well, ServiceNow benefited from the government's cost-cutting push during the first quarter with revenue and earnings that beat the street's expectations. The company also offering strong guidance, signaling solid demand in the software space. Joining us now with more, Gina Mastantuono, President and CFO of ServiceNow. Gina, great to speak with you. Thank you for making the time this morning. This stat really stood out to me, 30% higher sales in the public sector. Explain to me how a government efficiency push is driving an increase in government spending at ServiceNow.
Well, thanks so much for having me here, Madison. So first of all, I'm just so proud of the team and the execution to deliver this incredible quarter. So it's all about elite level execution at this rate and AI acceleration, which really helped us deliver that outstanding quarter. We beat our guidance on all top line growth and profitability metrics, subscription revenue at 20%, backlog at 22%, EPS up 18.5%. So a solid quarter across the board. And yes, really proud of our public sector growth at 30%. And you're exactly right. Federal agencies are really focused on modernizing and elevating how they serve the government, the American people. And what I would say is that driving outcomes, improving auditability, and eliminating millions of hours and dollars is exactly what the ServiceNow platform helps them deliver. And so now more than ever, these government agencies really need a tech platform that helps simplify the complexity and lets them become digital first. And that's exactly what the ServiceNow platform enables.
And Gina, every time I speak with you, I'm reminded of being at the Goldman Sachs conference and seeing a table filled with VC folks, all of them mentioning that this was their top pick stock in the AI space in particular. Talk to me about how you are viewing this particular moment in terms of AI and customer demand amid a lot of uncertainty about whether or not the CapEx on AI is going to prove out as a good investment moving forward.
Well, I think right now, more than ever before, leaders are so focused on the future and they're really focused on growth in and cost out. And so demand for AI capabilities, even despite the economic uncertainty, everyone is focused there because they know if they are not transforming, they're going to be left behind. And so we're absolutely seeing demand for AI translating into real transformation for customers. And so our AI products, we call them Now Assist, our net new ACV exceeded expectations once again, and this is still our fastest growing new product ever. And so we talked about a little bit on the call about our deals quadrupling year over year, and the average deal size is growing over a third quarter over quarter. And this is after our very strong and bigger Q4. And so it's not just about AI, though. At ServiceNow, 19 of our top 20 deals included 5 or more products. So it's about core plus our growth areas like AI continuing to do well.
Looking ahead, Gina, to what extent are you concerned that any kind of economic slowdown could start to impact ServiceNow moving forward? How are you thinking about that?
Yeah, well, I think if you just take a look at our guide, it really shows the economic resilience of the ServiceNow platform. You know, we raised our guidance at the midpoint for our revenues, and that's really because we're coming from a position of strength and momentum. You know, demand signals remain strong. And again, the customers we're talking to are really focused on today, but as importantly, focused on the future. And so I think we also were able to take a prudent approach that let us factor in some potential risks ahead, especially as it relates to the federal government, while at the same time allowing us to raise the guide. And so that really just demonstrates the economic resilience that this ServiceNow platform has for our customers.
And Gina, lastly, Guggenheim out with a note this morning pointing to 2 things in the guidance here, that new business did come in slightly below their expectations, and also that the guidance may not be as strong as first appeared due to some FX-related gains. As the CFO, how are you thinking about those currency headwinds and new business as well moving forward?
So our new business actually grew ahead of our expectations and allowed for that very strong beat on our current backlog. We beat that by 150 basis points. And so our new business was very strong. And we were very clear about the currency tailwinds in our guide, which allowed us to de-risk some of the back half of the year based on the potential economic uncertainty. But again, I was super clear that we are seeing no slowdown in demand and really just focused on a prudent approach as we think about the guide.
Yeah, making you an outlier this morning with a lot of demand slowdown coming out in earnings calls, Gina. Thank you so much for making the time. Appreciate it.
Thanks so much.
Coming up, we're going to dive deeper into the fallout from President Trump's tariffs across corporate earnings and the broader economy. Stick around. The fallout from President Trump's sweeping tariffs making its way into earnings season. Southwest, American Airlines, and Alaska scrapping their full-year outlooks on Wednesday, blaming uncertainty in travel demand. Meanwhile, faced with higher supply chain costs, PepsiCo says it no longer sees profit growth in 2025. Meantime, Merck expecting to lose at least $200 million to tariffs. That's not including those additional pharma levies here. Still with me, we have Joe Brusuelas to talk about this a little bit more. Joe, I keep hearing my sources who are markets guys telling me, like, well, the earnings, it's coming in better than we thought. It's all fine. As an economist, how are you reading these earnings?
No, no, and no.
Yeah.
Okay, no forward guidance is the problem because the economic environment is far too uncertain to make confident projections. I forecast in with the Wall Street Journal's panel. I'm on the board with UCLA forecast. Right now, you just can't do it with a measure of confidence. What you have to do is what they did at American Airlines. You talk to your investors with the adequate and appropriate measure of humility. We just can't project right now. What you're going to see, though, is that uncertainty, real quick, will extract a powerful economic cost. You're going to see orders begin to ease. Even in that durable goods orders this morning, what you saw ex-transportation, of course, Boeing orders were up 139%. Ex-transportation, they were flat. Again, tip of the spear. Yeah. You're going to see a lot more of that going forward. So I actually, when I hear a CEO say, look, it's just too uncertain, that gives me a little bit more confidence in them. I wouldn't really be talking about Q1 earnings, though. That's not, I think, a good place to be right now.
Well, we got to talk about what we're seeing on the tape right now. You're looking at gains, a huge relief rally, especially in the tech stocks here. You've got your NASDAQ up nearly 1.6%, your S&P 500 up over 1%. All of this rally really gaining steam off the back of Fed speak. Governor Chris Waller saying that the job market could prompt faster than expected rate cuts. Joe, is that something for the market to rally off of, or is it a sign that we're going to have a recession and then they're going to have to cut?
Yeah, there's a lot more hopium going on in the market today than I'm comfortable with. It looks to me like Governor Waller's trying to have it both ways, right? He's signaling, yeah, this is probably going to cause a recession and we might have to cut earlier. But hey, you know, the president can say whatever he wants. We're going to have our central bank independence. Oh, and by the way, the internal inconsistencies you're seeing here, that's okay.
And where does that leave us in terms of the outlook for the economy?
All right, so the economy is going to slow. At best, it's going to grind to a halt. At worst, we're going to be in a recession. I think we have a very mild garden variety recession, something that goes on for 6 to 9 months. To have a much deeper, broader recession, we'd have to have more profound policy errors than the ones we already have. Look, if we're going to avoid a recession, the administration's going to have to beat a hastier retreat on the tariffs. They're going to have to find a face-saving way out of this. Right now, it doesn't appear that way. You know, the real problem, Maddie, is they can't get their story straight.
Right.
The internal inconsistencies across macroeconomic policy inside the administration is really what's damping financial markets, and it's spilling over into the real economy. We just heard from WhirlPool and Southwest basically telling us the same thing, right? The CEO of WhirlPool was my favorite. He's pro-tariff, and we're mitigating tariffs by raising prices. Okay, I'm sorry, that's not mitigation, that's raising prices, and that's gonna tell you what's gonna happen once we get the price shock that's gonna show up in the next 60 to 90 days. That's gonna cause consumers to say, my disposable income just turned negative, I need to pull back.
Right, certainly something that we will continue to monitor. Joe, thank you so much, appreciate it. Coming up here, Zachary Warring from CFRA joining us with picks in the retail space that are well positioned to weather that potential recession. That's next on Catalyst. With tariff-fueled recession fears rising, which retail stocks are built to last? Zachary Warring, CFRA analyst, joining us now with names he believes are best positioned to weather some volatility. Zachary, great to speak with you. You sent us over 2 stocks here, both Ross and Lululemon. Let's kick it off with Ross. Where do you see this company is built to last?
Yeah, so Ross is just like TJ Maxx. They're both off-price retailers. They're very well insulated in recession periods or in a consumer slowdown because they offer lower price goods or 30 to 60% below retail value. We really like the company because of valuation. You know, TJ Maxx has a great business model, but their shares are pretty fairly priced at 28 to 29 times forward earnings. So you can get the same business model for a lower multiple at about 21 to 22 times.
And talk to me about a company like Ross in terms of the consumer it's exposed to within a recessionary environment. Is that a concern?
It is. They're both, both these companies, they really tend to that lower income consumer, maybe middle income a little bit, but you really are a little more insulated because, you might get some trade down in the higher income consumers looking to shop at TJ Maxx and Ross. So I think, as consumers continue to trade down in a recession, you might get hit at the lower income, but you might gain some more middle income consumers. And so it kind of evens out. They're not fully insulated. If, a full recession were to happen, you would see some earnings, lower estimates, but we think that's why, the valuation at Ross is very appealing.
Zach, are you not worried about producers who make their goods, say, in Vietnam, being caught up in not just tariffs, but the focus on transshipments, which has been a real emphasis of the administration during their first 100 days?
Yes, we do like companies that are out of China. We do think that, the other Asian countries are more likely to see some sort of, tariff resolution and much sooner than China. We think China is kind of the key player in these tariff debates with the administration. So, We like companies that are out of China. We think it'll kind of turn out to be similar to his first term. We think, the proposed tariffs on April 2nd that were delayed now 90 days, we think those are unsustainable. And we don't think there's any way that he can fight that many battles at one time. So we really like companies that are out of China.
So talk to me about your next pick for us, Lululemon, which, by the way, has been caught up in the huge TikTok trend of Chinese manufacturers saying that you can get Lululemon-style leggings directly from manufacturers in China, bypassing Lulu. They had to put out a statement saying those videos weren't accurate. Are you concerned at all about a consumer kind of boycott against a name like that?
No, we really like Lulu, and we like it because they have moved most of their manufacturing out of China. It's not even on their top 3 or 4 list of countries that they manufacture their goods from. So that's one positive. And, we've already stated that we really think that the administration can't fight the tariff front on all these different Asian countries at the same time. We think you're more likely to get resolutions out of the other countries than China. And then, we think this company has, over the years is, kind of goes in and out of favor with investors. But valuation here is just so cheap. Shares trade under 20 times, which is typically a great time to buy shares. And the price is back to where it was just a few years ago already. So, we really like the company. We think the brand is fine. They've continued to grow over the last 5 to 10 years.
Yeah.
They're not growing like they were, but their multiple shows that. And we don't expect their multiple to go back to what it was in 2020 or 2021 at 35 to 40 times. So.
Zachary, thank you so much. Really appreciate it. Joe, I've got time for about 2 sentences from you. Your big takeaway on where this economy is heading in the market today.
We're going to slow. There's too much hopium in the market. I think risk needs to be pulled off the table as we head into the weekend.
All right, very good analysis there, Joe Bruce-Wales, and perfectly timed for that. Thank you so much for joining me as my guest host for the hour here. Coming up for our audience, we've got Wealth. It's dedicated to all of your personal finance needs. Our own Brad Smith, he has you for the next hour, so stay tuned for more.